Can you claim your interest expense when borrowing for shares? This is a question that somebody recently asked me, and as always with tax advice, financial advice, I would suggest that you speak to a professional given your situation and circumstances, because often people ask questions and they get a generic response to things like this, and then it takes a tax professional or financial advisor to unpack exactly what they're trying to do, and you may come unstuck. But with that said, even the IRD have a resource on their website telling people that if you are borrowing with the intention to buy stocks, to buy and sell those, then the interest may be tax deductible. Now, accountants always use lingo like may be tax deductible to sort of de-risk the situation a little bit, given that people may miss some of the details. But also it then says that even if you're borrowing to purchase stocks that are going to earn you income, i.e. dividends that a company pays out, then it may be also tax deductible. Now, there's a few things in here. What is tax deductible? Now, in this instance, basically what we're saying is that if we borrowed money in order to buy some stocks that pay a dividend, we're going to have a dividend income, but we have a cost of that debt being the interest cost. Now, repaying the debt is not a tax deductible expense. Many landlords even get this wrong. But the cost of the interest would be an expense for you, and now you've got your dividend less your interest cost, and that equals your profit. Now, another way to think about this is basically if you were running a business and you were to buy an asset like a digger, the interest cost on that digger would be tax deductible as well. So you would have your revenue from your digging minus your expenses, including the interest cost for the debt on the digger, and that would give you your profit, and you'll pay tax on your profit. So back to our person who's buying shares with debt, then the IRD rules stipulate that they should be able to claim the interest as a tax deductible expense, because there's what we call a nexus, or a relationship between the expense incurred and deriving the income, i.e. the dividend. So hopefully that gives you some background to it. And another way to understand it would be that people who buy property have been doing this for some time. Now, obviously, people build up equity in their property because the currency is devaluing, they're creating more debt, and so the property on paper is worth more, and our debt has hopefully decreased, and so we have our house value minus the debt equals our equity, and then we go and leverage that equity to buy another property. And when I say we, I mean New Zealanders over fucking decades, and we doesn't include me. I have not done that, but obviously I work with clients who do this. It is a wealth building tool that people have lent on in New Zealand. Now, they can claim the interest cost of that debt if they are renting that property out. But if you are buying a property in New Zealand for yourself, then you can't claim the interest as a tax deductible expense because you're living in it. So just a distinction there. When you're buying the property for yourself to live in, that's very different to buying a property to rent out, because again, there's no nexus or relationship between the cost of that debt and income, because when you live in it yourself, you don't have a form of income, so therefore you can't claim an expense. I believe in some countries you can, but I haven't looked deeply into that. But you would have your rental income minus your rates, your insurance, your repairs, your body corp, your bank fees, your accounting, etc., and minus your interest, and that would give you your profit, and you would pay tax on your profit. Now, we know that I think it's over 1 and 2 rental properties in New Zealand, it's probably even higher, don't actually run at a profit, so their expenses outweigh their profit. So the loss for them is then carried forward to a future year, and it may offset profits in the future or other rental investment profits that they may have. Now, why I then point this out is because then why then do these people buy rental properties if they don't make any fucking money? If they don't make a profit, when most things you don't go to work for free, you don't go to work and then pay to be there. You don't invest in a lot of things or do things where you're not going to be able to make money. Eventually those fall over and they collapse and they end up in the media, etc. So why do then people buy property? Well, they buy it because they have a belief that the property is going to go up in value and they're going to make a capital gain. And in New Zealand, we don't have a capital gains tax. So what does that mean? Well, they have economic income, which is the increasing value of their asset or their property, which is untaxed. But the earned income, i.e. the rental income less the expenses, that's not taxed either. Well, it would be if it was profitable, but it's not because it's run at a loss. So that's why so many people like buying a rental and running them at a loss, banking on the fact that it will go up in value in terms of the capital gain, and they won't have to pay any tax on that. So that's kind of, you know, how our tax system works and how we've sort of gotten to where we are, because we've been doing this for some time and it's sort of been tried and true. But I hope that that helps you understand it, and I've articulated it in a way that you're like, oh, okay, that's why people do that. Now, a lot of people, they will argue that no, that they're not doing that for the capital gain, because, well, I'll come back to this, but they will say, no, I'm trying to protect my wealth, which that's a fair argument, because as debt increases and money becomes worth less, people have to figure out, well, where am I going to store my excess cash? And so they're doing that via property, because to them that's been safe. Now, actually, in New Zealand, we have an intention rule. So that intention rule says that if you buy something and you expect to make a profit, your intention was to make a profit, therefore you should pay tax on the profit. But most people would argue that when they buy their property, no, I didn't have an intention to make a profit. I had an intention to get paid a passive rental income stream. But you can kind of call bullshit on that, because so many of them run at a loss and don't really create a passive income stream. Now, if we then contrast, because it's, you know, run at a loss obviously, but maybe it does in time, but that's how they can then justify not having to pay tax on the increase in the value of that property sale. Now then, the Bitcoin community, they're filthy on that, because if they buy Bitcoin and they don't have an intention to make a profit, but they do sell at a profit, it doesn't matter for them. They have to pay tax on it under the current rules. So if their Bitcoin goes up and doubles in value, well, they need to pay tax based on their marginal tax rate, and there's no real getting around that. Some people that have made mega cash in the crypto space have left the country and gone, I'm not for that. Now, a lot of Bitcoiners will you know, they will tell you that the reason they invest into Bitcoin and crypto is because they're trying to protect their store of wealth. So the tax rules don't really line up across that. Now, that's just a side bit, because we're so deep into this tax lesson, I thought you might be interested in that. But then, and I'm not to say that it's right or wrong or what's fair or what's unfair. I'm an accountant. My job is to understand the rules and help other people understand them and navigate the way that people are playing within the game, and understanding when they change as well. Now, if we bring it back to then our share investor, well, they're effectively doing the same thing. So they're going to borrow credit and debt, which is going to incur a cost, and then they are going to invest that money into the stock market. And yes, they may get dividends, and that's the ability, that's the part of the tax rules that then give it the ability for the interest to be tax deductible. But realistically, most of them will be banking on the value of those shares going up in value and becoming worth more. And therefore, when they sell those shares, they don't have to pay a capital gains tax, because we don't currently have one in New Zealand. Now, the caveat there, you need to understand the fifth rules in New Zealand. Now, basically, if you own stocks and you spend over $50,000 and those stocks are come under the fifth rule, so a lot of overseas stocks, you have to Google this to look into it more, it'll take a whole another video, then you may have to pay tax on the value of those stocks. But again, you may have purchased those with debt. But anyway, if we just keep it simple and say someone's buying some New Zealand stocks because they truly believe that these New Zealand companies are going to go up in value, and they take some debt out in order to do that, they should be able to claim a deduction on the interest. And if they were to go up in value, they probably don't need to pay any tax on the capital gain, because they will argue, well, I didn't have an intention for them to go up, I was buying them for the dividend. So you might want to be careful, like buying speculative stocks with debt that don't actually pay a dividend, because there could be the argument, well then, what was your intention to be purchasing it? Probably less likely if you're not leveraging and using debt for the IRD to ask that question. But if you're claiming interest on your debt to purchase some of these assets, like the IRD can ask questions, and you will be asked to explain yourself. So again, that's why I say, make sure, when you watch a generalized video like this, to understand some of the concepts. You don't take it for tax advice specific to your situation nor the share that you are purchasing. Now, I actually had a message from somebody recently who basically said that they borrowed against the equity in their property to buy more stocks. Now, why did they do that? Well, they did that because they don't want to go down the property investment route. So what they did is they took the debt and they purchased more shares, and that is each to their own, but that is not common in New Zealand, nor from what I see, and probably not financial advice that a financial advisor would give, because it's just not really the done thing to do here in New Zealand, because we live and breathe property. And oh yeah, there's just people standing in the middle of the street, as you sort of do, blocking people from going to their work. But anyway, so that is obviously why this person was looking to do that, is to maintain the tax deduction, and basically make a bet that the value of that debt is going to go down, and the return from the stocks are going to outweigh the cost of that debt. And that's also why many people wouldn't do it, because they can't handle the volatility, the risk based on risk created via leverage, i.e. more debt, and they probably wouldn't back themselves to beat the cost of that capital unless they can get cheap capital. And maybe they're getting cheap capital by borrowing against their property. But anyway, they have invested into high risk stocks, and they are confident that they will beat the cost of the debt. And if there is a drawdown, then they will, in terms of the stock market going down in value, they will need to maintain servicing that debt. So there's that's one point there. But then the other bit, there's a big perception in New Zealand that you can't borrow against shares. Well, but you can borrow against your property to buy shares potentially. You'd obviously need to speak to a good mortgage advisor and financial advisor before doing any of this, of course, as well. But also perception that you can't borrow against shares. Well, actually, some entities do allow you to borrow against shares. Now, it might not be the full amount, or it might not be based on the same rules as property. However, you can leverage stocks that you own, and it is actually doable. Again, we don't talk about it a lot because it's not really done, and it's very, very risky. Anyway, I hope that helps answer the question. It's one of those things that someone asks me, and I wonder if other people will be keen to learn more about that. So let me know if you would want me to cover more of these kind of little tax pieces, and then go a bit deeper on them for you.